Video, we're going to look at another advanced transaction involving sales returns. So if a customer buys goods and they find that they're defected or damaged, they can return the goods. So this process is more difficult than the purchase returns because the business has purchased some goods, they've then sold it on to a customer. That customer has then come and returned the goods because they're faulty. So there's a lot of transactions, a lot of accounts involved here, and a lot of negative accounts as well. So let's have a look at the transaction that we're going to try to process. A customer returned a pair of $99 Nike shoes because they were the wrong size. A full refund was given. The cost price of the goods was $50. We're going to split this transaction into two parts. Firstly, we're going to deal with the sale price, then we're going to deal with this cost price. So firstly, this sale price, $99, there's going to be a new account called sales returns. Cash at bank's also going to be affected because we returned this $99 to the customer. You can see here, full refund was given, and there's going to be some GST implications there. So let's deal with that first part. The date, let's just use July 1. First account affected, we're going to call it sales returns. Now, sales returns is a special type of account over here. Under revenues, you can see here sales returns and allowances, and it is a negative revenue account. So I'm going to call this negative revenue. Normally, revenue accounts are credits by nature, but because this is negative, it's going to switch around. So this is going to be a debit by nature. Sales returns has increased, so this is going to stay as a debit for the X GST price. So we're going to go 99 divided by 1.1. It's going to equal $90. Let's now deal with the GST account. So because it's a sale, it's going to be GST collected. GST collected is a liability account. Liabilities are credits by nature. Because we're returning, or these goods are getting returned, this account's actually going to decrease, or the amount of money we owe the government is going to decrease. So this is going to change to a DR for the GST amount, which is going to be $9. The final account is going to be our CAB, our cash at bank. Cash at bank's an asset account. Assets are debit by nature. We're giving a full refund, so we're returning to the customer $99. So our bank account's going to go down, so this is going to switch to a credit for $99. You can see here our two debits of $99 equal our credit of $99. The second part of the transaction is down in here. We're going to deal with the cost price of the goods being $50. So the two accounts affected. Let's do inventory first. Inventory. Inventory is an asset account. Assets by nature are debits. So what's actually happened to our inventory balance? Well, a pair of Nike shoes has been returned. So our inventory balance is going to go up. So our inventory balance is going to go up. So this is going to stay a debit for the cost price of $50. The final account affected is cost of goods sold. Cost of goods sold is an expense account. Expenses by nature are debits. Now, this is a little bit tricky, but basically we know from this entry here that this is a debit, so this has to be a credit of $50 because our debits must equal our credits. Therefore, this account here must decrease. So our cost of goods sold, that account is going to decrease by $50. Now that's a little bit tricky to get your head around. There's no really good explanation for that. That's why I work backwards with that transaction. That's the easiest way to remember it. That's it. That's a transaction.